one of those big looming debates that exists in the real estate market and the real estate investing industry. And that's going to be cash flow versus appreciation.
You're listening to the Real FI Podcast, where we discuss time-tested tricks, techniques, and strategies for pursuing financial independence today, so that we can enjoy a better tomorrow. Financial independence isn't about getting rich quick. It's about cultivating a foundation to grow financially, mentally, physically, and spiritually. Let's figure out how to kick the 9 to 5. Here are your hosts, Patrick and James.
How's it going, everybody? And welcome back to another episode of Thinking Out Loud on the Real FI. I'm your host, James Ripion, and I'm here with my co-host, Patrick McGrath. How's it going, Patrick?
Oh, it's another great day, James. Another great day. Man, I'm excited trying to get this thing going, but we're going to leave this in because we don't care about bloopers.
No, that's how we roll. That it keeps it all fun. You can't take it too seriously. And that's what we're here about. We're here to, talk to you guys about financial independence and some of the path to get there and the different routes you can take. And we just wanted to tackle that head on and talk about one of those big looming debates that exists in the real estate market and the real estate investing industry. And that's going to be cash flow versus appreciation. There's a lot of different approaches to those two investment styles, different ways to invest in real estate using both of those. But, I think that's going to be a really fun topic for us to kind of dive into and give our perspective on, and kind of just pick apart. Because I know that, I used to always think one way, and then having a whole bunch of experiences in the field and with real estate kind of gives you an appreciation for the other side of the coin. And then as you get years of experience, not to say that I'm an expert or anything, but as you learn more, you have an appreciation for the opportunities that are out there, when it comes to cash flow versus appreciation in real estate assets. So I think it's going to be a good talk. If you have anything just general you just wanted to say about the topic, Patrick?
Yes. So it is the great debate. And I'm sure, over the last decade, people's opinions have changed a little bit given how much the market has appreciated.
Months, man.
18 months, 3 years, decade. Yes. I mean, I think there's a lot of geniuses out there. And when I mean that is you could have bought almost anything in the last 3 years, 5 years, 10 years, and would have a home run at this point. So there's a lot of people that have made a lot of money off of appreciation. So that's kind of the great debate. Do you buy for appreciation? Do you buy for cash flow? Wouldn't it be nice to have a little bit of both? So that all really comes down to your market and everything else. And that's what we're going to jump into today and give you guys our opinions, which again are just opinions. So take them how you will. Hopefully we can give you some nuggets for you to go out and make better decisions. But don't make any financial decisions off of us because we're just two regular guys on our own paths to financial freedom. And hopefully we can help you out and just give you some different things to think about when you're going to make your own investment choices. So let's dive into it today, James. Let's start with appreciation. So what's your opinion on appreciation, current market with appreciation? Let's dive down into that and get started.
Well, I think the most obvious thing is, you hit the nail on the head earlier. You just couldn't have lost with appreciation. And we see these markets change over time, as people enter the market, assets start getting bid up in price. It feels good while it's happening. And then you can almost at times lose sight of some of the downside because the immediate benefit of price appreciation takes over. It becomes a mania. I think the best example of how this kind of went awry, and this is kind of speaking to the cons of appreciation, is 2008 financial crisis. Everyone and their mother was buying real estate to make a whole bunch of money in the appreciation game without any regard to the cash flow or the back end financing of how the deal is structured. It was almost an afterthought. Like, we can get this property, it's going to keep going up. We can refinance it, buy new properties. We don't have to hold on to these things for more than 12 months, and it's just going to work out. And I think what people with appreciation kind of lost sight of is the numbers, taking care of all the expenses, paying your taxes, your insurance, all the utility bills, tenant turnover. I mean, you had people buying properties and leaving them vacant, and not even putting tenants in there just because of how much they're appreciating. That's how they're just making money. They weren't even flipping properties. They were just buying, holding, and then selling again or refinancing to buy another one. Now, kind of looking around what's happening today, are we seeing something similar to that? Maybe. There's a lot of money entering the market. You have huge institutional buyers like OfferPad coming in, scooping up properties, BlackRock just buying properties to hold on to, institutional and foreign investors just scooping up a whole bunch of deals. It's a place to put your money and protect against downside risk with, the dollar or something like that. But I think that would be one of the cons, is these huge market shifts that happen, that people, get into the real estate game for the appreciation, but they don't have an appreciation on the back end of, what could happen when things go wrong, when prices go down, when your loans start being called, when you can't refinance. I think that's a big con. So I guess we're going to start on the downside of things, and then work to what the benefits are, structuring your deals and real estate strategies with appreciation. But what are your thoughts on that, Patrick?
Man, I completely agree with all of that. I mean, the big thing with appreciation right now is a majority of Americans and majority of people who have bought houses have equity built up in their house. So people are taking out home equity loans, home equity lines of credit, because interest rates are low, they have the equity. And one thing about your home equity loan or your home equity line of credit is that the banking institution that you have that through can call the loan at any time. That's in your paperwork. That is in all of that. And a lot of people don't realize that. So if the market takes a huge turn, they can call the loan on that. If the interest rates, go up significantly, which has a potential of happening this year into next year, your interest rate can climb significantly and they could call the loan. So that's another downside of the appreciation, is people taking on a lot of this equity and, using that capital most likely for not investing. There are people out there that do that for investing, like myself and like other investors. But the typical, person is paying off debt, credit cards, different things like that. And that can get you in a bind. And because we're in the euphoric stage right now, where, I just got an email from the 2 properties that I sold last year in the zip code area. Zillow will send you, market updates for next year. 12% increase is what they're projecting for 2022, and it was 11% for last year. So if you have a $300,000 house, that's 30 grand in a year, and they're projecting another 30 or 40,000. So that's a positive, but also a negative at the same time, because you're pricing people out of the market. And it is a disadvantage because people can't get into the homes. The prices are going up. But one other thing to think about, and to piggyback off of what you said about, these big firms like BlackRock and some others that are coming in and buying up neighborhoods, and like Zillow, what they were doing was buying up homes and thinking that they could renovate them and sell them, is, in the 2008 crash, it was the people. It was people taking out loans that they couldn't afford, institutions giving that money out to people that they couldn't afford. This time around, you have these big companies that are now buying the assets and that have a lot of um, that have a lot of their books in these assets. So if we get a market turn, now you have, you know, a lot of the top 100, 500 companies with all of these assets that have the potential to significantly drop, and that will take the whole stock market down with us. So it's not just the people that are going to be affected by that. It's by these big institutions, and it's going to cause a giant ripple effect, which is different from 2008. So there is, not to be all doom and gloom, but there is some disadvantages to, you know, having skyrocket appreciation. What do you think about that, James?
I think what makes me upset about the whole situation is how unaffordable homes become for those people who want to buy their first home. You know, I'm pretty young and I'm looking around, like I'm not in the house I'm going to be in forever, but and I'm probably not in the market I'm going to be in forever. So this is one of those interesting dynamics that I don't think people look at. If you know you're going to end up in a different market, those houses are going to appreciate at a vastly different rate, especially today. So you know, my wife and I, we moved to North Carolina from Maryland. Maryland has, generally speaking, just a higher cost of living. Real estate prices are more expensive. And over the past 18 months, because of COVID, we've seen prices just skyrocket. We moved to a Fayetteville, North Carolina. It's a city, Fayetteville, Fort Bragg, big military installation here. But prices hadn't been appreciating as fast. So it's actually been a little bit slower of an appreciation. So with all the craziness going on, we've actually net lost out on the opportunity with moving down here because prices, because we sold one house, bought a new house. The one we sold had appreciated more. The one we bought had appreciated a little bit less. So there's like this opportunity cost. So I think that's, you know, with all the appreciation going on, that's something that people maybe don't think about, especially when they sell a home. Geez, I see this all the time. You know, as a real estate agent, people are selling a house just because it went up in price. And then what are you left with? You're left with cash. Do you have something better to put the money in that's going to either grow at the same rate as the asset you just sold or more? Because that's really the only reason to sell it, unless you need that money to put towards a different use. So I think that's a huge con with all this appreciation, is that it gives people a false sense of security. Then, you know, that they almost rationalize shooting themselves in the foot on a real basis. And if you don't get what I'm saying with a real basis, you have the nominal appreciation and then the real appreciation of that asset versus everything else. Whole conversation to be had about that, but I think that's something that this appreciation market has done, is it's just drove prices up. It's made people sell. They're selling to institutional buyers. It's making, you know, first-time home buyers have a difficult time buying houses. And then on the flip side of that, what does appreciation do on the rental side? Rentals are going to start skyrocketing too. It makes rents less affordable for people. As an investor, you know, I'm looking to increase rents all the time. Like that's how I'm going to cover my expenses. You know, I'm buying more properties, you know, especially lately, labor costs, material costs have been going up. So it becomes more expensive to maintain these properties, but ultimately, you know, rents have to go up. And the reality is it can only go up to the amount of income able to support those rents. So you're having this, you know, divergence of like appreciation of value versus what rents could realistically be. And this is just an interesting phenomenon to keep an eye on.
It is. And like I've noticed this over the last couple months as well. As so we have like a community page for where we live, and there is so many people that are complaining that they've sold their house, they have to be out in 30 days or 2 weeks, and they can't find a place to buy, they can't find a place to rent. I mean, you know, I'm looking all of the time on what other people are putting on the markets for rent, just to compare what my units look like, the pricing, all of that. And there is barely anything available. And the things that are becoming available, the prices are just like blowing my mind. I saw like a 2-bedroom, 1 bath above a garage going for like 1750 that had been renovated. And for instance, I'm renting, almost 2-bedroom, 1 bath townhomes, like a duplex townhome for 1250. So I'm sitting here like, holy crap, that's a $400-500 difference. And there's nothing else on the market, so people don't have options. So people are, and like you said, it's a false sense of security. Like, oh, okay, I have this, I'm going to make 100 grand, but I'm going to pay 100 or $200,000 more for a house right now. So you're getting into this whole thing, and also with labor costs going up, with building costs going up, they're not building starter home communities anymore at all. So your first time home buyer has the option to buy an older home built in the 50s, 60s, 70s, or they're going to be put into a 2-2 or a 3-2 townhome that in Maryland is going to cost you a minimum 350, if not closer to $500,000 for a townhome. And if you want a single family, you're talking, 4 3s to 5 3s, and they're starting at 600 for, a single family home with on 1/5 of an acre yard. And those are the communities that they're building now. So with this appreciation, it's pricing a lot of people out of the market, and people are staying put. A lot of people aren't selling, which is why we have a supply crunch, because they can't find anything. So, that's another disadvantage. And I totally agree with everything that you're saying, man.
Yeah, and I'm wondering if that might be causing some of the quality of construction changes that we've been seeing. Because when I look at my market, things built from the 50s to the 80s, you can find a 1,200 square foot, 3-bed, 2-bath, brick, solid house, good family starter. I haven't seen something like that. I haven't been selling real estate, for very long, but a new build like that, I don't think I can see having been built since like the 90s, maybe. Now, houses are just exploding in size and square footage. They're huge now relative to where they used to be in size. Also, they're made out of shit materials like vinyl siding and, just things that don't stand the test of time, and they frankly just don't look as good. And it's just interesting. Plus, like the interior finishes on new builds now just don't look great. You can just tell that there's this weird expansion of the footprint, but not the quality of build. I'm wondering how much that has to play with the appreciation we're seeing and just how all the economy works together. Not sure how related that is. Just a weird observation.
Everything's composite. I mean, even the joists now, they're not even 2x10s or 2x12s. They're composite board, because they have to drive down the cost, because people want larger homes. Like you said, I mean, our first home was 950 square foot, 1 floor with a partially finished basement. And that was a starter home in the 50s, 3-bedroom, 1.5 bath on a 1/4 acre. You can't get those anymore. We bought it for 190,000 in 2013. It's worth 360,000 right now, and we sold it for 320 January of last year. So, it's just crazy. All right, so those are the disadvantages. It's not all doom and gloom. Let's talk about the advantages of appreciation, especially when it comes to, real estate investing and just your average home buyer out there. What do we got?
Oh, there's way more probably than there are disadvantages. I think an interesting thing to think about is timing your entry into an appreciation asset versus cash flow. And just big picture thinking, I've always kind of considered the appreciation play kind of like a down the road kind of investment strategy, because you are making a risk, for all the cons that we talked about. That's kind of why, because you want to be in a good financial position to weather those turbulent times. Appreciation, from everything we've said so far, if this isn't clear, it's a time in the game strategy. It's a long-term thinking, systematic way of buying assets that are going to appreciate in value. It's not the things that we have been seeing over the past 18 months, I think, are not normal and probably shouldn't be expected from now into perpetuity.
Exactly.
24 months ago, everyone was looking at appreciation as, I'm going to buy this asset, hold it maybe 5 years minimum, see what the loan balance is looking like, see what the values are, have all that debt paid down, all the favorable tax, implications of owning real estate, and then think, if I want to hold this, refinance it, hold it outright, or maybe sell it in 1031. And it's always been a long-term game. Now more than ever, I think that kind of needs to be the consideration. But I think the benefit to an appreciation play is that when you're in a good position to be able to take advantage of it and buy assets that are going to appreciate, it's going to exponentially increase your possibilities for the future. Mostly through repositioning that asset, either through recapitalizing it, refinances, or selling it in 1031s. So I think the pros are, with a systematic approach to finding a good market. And we'll talk about this a little bit more in the cash flow section of it. But if you find a good market that's ahead of growth, you're going to be able to pull that money out and keep buying additional cash flow into the future. I think that's ultimately what people are trying to do. Me specifically, everyone's got a different strategy, but I think the biggest benefit is going to be the refinancing, pulling that money out and buying additional assets to leverage into new deals.
I agree. So the way that I look at appreciation is kind of the icing on top. And like you said, when we get into cash flow, we'll dive a little bit deeper into that. But I wouldn't necessarily buy property solely for appreciation, because you don't know. People could be buying at the top right now. There could be a crash around the corner. No one really knows. Anyone who says they do are lying to you. There's too many factors at play. But one of the advantages is, if you live in a market like New York, New Jersey, Washington, D.C., Maryland, Virginia, and you've had this massive appreciation right now, and you have the opportunity to work from home, you can capture that appreciation by selling your house, by making that 100, 200, upwards of $300,000+ over the last 24 months. And you can move to a market like a Fayetteville, North Carolina, like outskirts of somewhere in around Atlanta, move out to the Midwest, which people have been doing, and you can get more value and more dollar, per house out in some of these other markets, because maybe they haven't appreciated as much, or just the cost of living is significantly less than some of these metro area markets. So I think that is a huge advantage, as well, especially as work has changed for a lot of people, with the ability to kind of live where you want, work where you want. So that's an advantage of the appreciation market that I don't. If you sell your house in your area and you want to stay in your area, well, everything else has went up too. So it's kind of a moot point. So I think that's another positive there, that some people haven't really thought about. And yeah, repositioning the asset is huge. We have a problem now, though. Interest rates are going up. So, you have $100,000, $200,000 in equity now, but your mortgage is at 3%, and now you're going to get possibly a fixed rate at 4.5, possibly a variable rate, and we don't know what's going to happen with that. So there's a lot of different factors that you have to weigh right now with the benefits of this appreciation. It still makes sense given that inflation is, extremely high. So that makes a lot of sense. But, there's a lot of positives. There's some negatives, but for me, the way I look at appreciation is I kind of look at it as the icing on top. Whatever I'm buying, I know it's going to be a solid investment throughout the long term. And if you look at the housing market, over the last 20, 40, 50, 70 years, properties are going to appreciate between an average of, what would you say, James? I think it's 3 to 5%. If you look at, the data going back that far. So you're going to have appreciation. But again, it all over the long term. If you buy a house this year, say 5 years from now, you might not have that. You might not be in the same position because we don't know where the market's turning. But over the next 10 or 15 years, you have a lot more likelihood of seeing that appreciation with those long-term data points. So
I think with the whole arbitrage conversation of, selling your house where you're at now and buying somewhere where you can live at a more affordable or lower cost of living is something that I think most people who are looking to get into real estate investing should definitely take the opportunity to do if you can work remotely and have that income coming in. And it reminds me of this Warren Buffett quote, price is what you pay, value is what you get. A house, here is pretty much going to be the same exact thing as a house somewhere else. There might be differences with location and its proximity to major metropolitan areas. But, for what the asset is, it's pretty replicable across the whole country. But just certain areas have a higher price. There might be some inputs into that which make it have more value, such as the things we've already discussed. But price is what you pay, value is what you get. If you can find more value elsewhere in good growing markets, and that's an important thing. You don't want to move into the middle of nowhere where you're not going to have further appreciation. But if you want to move into a new market that's going to continue to grow, there's job growth, employment growth. I think that offers a lot of opportunity there.
Huge, 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 huge. All right. Now let's get into one of my favorite topics, which is cash flow. So buying for cash flow. So me personally, this is what I do. This is how I run all my numbers. This is the only reason I'm currently buying and adding assets to my portfolio is strictly because of the cash flow. Like I said, the appreciation is going to be the icing on top. And one thing we've totally forgot to mention is forced appreciation, which I think we can kind of get into with the cash flow. But that's how I'm looking at and buying assets. I want to have the cash flow cover all of my expenses, and be able to walk away with some money after taxes. And that's how I look at a property, because if it can function by itself and run by itself, and other people are paying down the debt, other people are paying for the expenses, I can hold it for the long term and get the benefits of that standard 3 to 5% appreciation down the line. So when I'm, 50, 60, 70 and decide to sell off some of these assets, I will also get the benefit of the appreciation at the time I decide to sell. So that's kind of my little take on cash flow and why I buy for cash flow. But James, I'm really looking forward to hearing your thoughts on that and diving a little bit deeper into this.
Let's get real here. You can't retire on appreciation alone. Like if you buy one asset that is not divisible, let's just call it real estate. You got this one piece of property. Let's call it, let's just one. I'm trying to think of what kind of asset would be perfect for this, but let's just say it's a vacant piece of land. You got that piece of land and you buy it and you think this is going to be everything around it's going to develop and it's going to appreciate 3-4x over the next 8 years. Good luck retiring off that and having income to live until the time that it actually retires, until the time you retire, unless you're, selling timber on an annual basis or, renting it out to a farmer or whatever, if it's large enough to do that. I think that a lot of people's goals when they come to listen to, content like this is to find ways to reach retirement, and cash flow is going to be one of those best practices for getting there in a safe and reasonable period of time. I think that appreciation is sexy, and it can be the icing on the cake, as Patrick is saying, and it can give you a lot of benefits to leverage into more cash flow if done properly. But ultimately, I think that when people, don't look at that speculative land development play, but rather find those, 3-unit, 4-unit, multifamily deals that they can get into early on, hold them for the long term, keep them, and then get to that retirement stage, you're going to collect passive checks. I'm using air quotes now for the people who are listening, passive, but you're going to have a stream of income that can come in to provide for your retirement, provide for your monthly living expenses. Appreciation, isn't necessarily going to do that. So I think that ultimately that's the biggest benefit. That's what we're all here for. People who do the appreciation plays, the developers, the flippers, the wholesalers, they all want to be in the cash flow side of things. Like they're doing what they got to do to get to where we all want to be.
Exactly.
I think that's ultimately it. What do you think?
No, I mean, I really couldn't agree more. And I think cash flow gives you the ability to play the appreciation game. If you're bringing in whatever your goal is, say 10, 15, $20,000 a month in cash flow, you've built up your real estate portfolio, you've worked. Now you can take some of those higher risk, higher reward plays. And if, one doesn't work out, it's not the end of you. That wasn't your retirement game. That's not going to affect everything. The beautiful thing about cash flow is it comes in every month. So, I'd rather take, $10,000 a month cash flow over $150,000 win, because once that 150 grand runs out, it runs out. But I've got assets that have built up my $10,000 a month return. That's $120,000 every year until I sell. So, I'll take that reoccurring investment. And when the banks are looking at you, they want to see the reoccurring investment. When you do your net worth allocation, you go into for financing loans, they want to know how much equity you have. That plays a small part in your net worth, but they also want to know how much you're bringing in. And I guarantee you them seeing, a significant amount of cash flow coming in, it's going to sway their way more than saying, oh, well, I own this beach house that has 250 grand sitting in it, because that's not liquid.
I think that's a great example of, comparing kind of what you're doing versus what I'm doing. I've got a lot of assets and wealth in Bitcoin. Bitcoin doesn't shoot off free cash flow to me and put something on my personal financial statement, my income statement, that a bank is going to like to buy that, uses collateral or income to buy the dream house, the next investment asset. Patrick has all this rent coming in. He's got all this assets being built up with appreciation and debt pay down. And he has something that financial institutions want to look at to lend against. And it works in his favor that way. So I think cash flow, gives you that foundation to build on. And, people always, fight with themselves on where to start with their wealth building journey. And there's no right place to start, but there's these blocks that you just have to lay as your foundation to build upon. And wealth becomes a hockey stick sooner or later as those efforts compound on each other. And the appreciation play is what happens, I think, as a result of having the cash flow in the foundation, especially when you're going to weather these times of unknowns. If you have enough to just get through everything, it's going to set you up for good success.
100%. And, I always ask, because I've got this question a million times on my Instagram. I do answer questions on there. And people always ask, and I say, why can't you have both? Like, you can have cash flow and appreciation. The biggest thing is you have to force the appreciation. And that's through buying undervalued assets, in the market, knowing your market, and then doing all the right things, renovating the property smartly, changing out the tenants, increasing the income of the property, especially if it's, commercial property, 5 units or more. But even if it's a single family, 2, 3, 4 unit, it's doing the renovations to bring it up to market, and you can force the appreciation higher than what the appreciation in the overall market is. So you can get the best of both worlds if you're buying right and you're knowing your market. You can take, for instance, we bought a triplex for $200,000 back in 2019. So over the last 3 years, we've had, let's call it a 20% appreciation for simple numbers. So that means that would be worth, 220,000, or 10% each year, 240,000. Well, we renovated the property and it's worth $375,000 now. Has nothing to do with the income on a triplex. It has everything to do with what the comps are in the area and the finishes. So we forced that appreciation. So now we've got the cash flow that we get every month, and we've got the forced appreciation. So you can have both. It all really depends on your investment strategy. What do you think about that, James?
I think that there is no bad market to be an investor. There's just a different market requiring different strategies, and you can't have both. Maybe you can't have both 100% at both, at all times. You might have to, when foreclosures start picking up and, we have more cash flow deals that are, easily accessible, and retail isn't bidding the hell out of all these prices, and you don't have all these institutional buyers, you might be able to find deals closer to, the 1% rule that cash flow a lot better, as opposed to like this crazy appreciation market where you can get in there and do flips, and you can do this forced value add, as Patrick was talking about, finding those mom and pop commercial deals that are undervalued rents, and that you can go in there, get rents to market, refinance, and buy the next asset. Every market is a good market for investing. You just need to be willing and able to have an appreciation of that market and know how to pivot. So I think, having both of those strategies worked in, neither is inherently good, neither is inherently bad. You just need to understand what the risks are with both of them, and the benefits and the drawbacks. So that's kind of how
Exactly. No, that's a great way to look at it. So a couple key takeaways from today. You've got to pick your way of investing. Are you going to be an appreciation investor? Are you going to be a cash flow investor? Are you going to be a value add investor and try to do a little bit of both? Are you investing for the long term? Are you investing for the short term? So you've got to do your due diligence in figuring out what your ultimate investment strategy is. James and I are here to, spark your interest, to spark your mind, to make you think about different things and get a little perspective on how we invest in our separate ways. And hopefully, that drives you to go out, do your own research, pick your own markets, and figure out the ultimate way that you can be financially free and build wealth for your future to become ultimately financially independent. So, these two topics are probably going to be debated on till the end of time. So that's just our little 2 cents on this spin. Please give us some feedback. Let us know, how you invest, why you invest in cash flow versus appreciation. All of that, we'd love to hear from you guys. The email address is in the show notes in the back. James, anything before we sign this one off?
Yeah, let us know what we missed. If you guys know that there's some other benefits or drawbacks to either appreciation or cash flow investment strategies, let us know. Like, we want to educate ourselves as well, and we want to make sure that we're bringing the best content to you guys. So just give us some feedback. Also, drop a review if you can. We'd love to hear what you guys think of the show. Good, bad, ugly, let's hear it. We want to improve this for you guys so we can be a valuable asset to you moving forward. If you have any questions, you can reach us an email at info@therealfi.com, and we'll be happy to get back to you. Other than that, I think that's all I got.
Yeah. And hey, if you think you can bring value to the show, and would love to have James and I pick your brain and put some content out there for people. Do the same thing. Hit us up, Instagram and the email, and we will see you guys next time. Thanks a lot, guys.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.